Okay, so this is a video about central banking for PACE. In particular, we want to answer some questions regarding the processes by which states do finance themselves. So, more precisely, the question people often wonder is why on earth are we, or meaning the state, helping the banks, and then these banks do get cheap financing through the central bank and immediately relent that very money to the state, but at very high rates. So this is kind of a paradox that the states are actually helping banks, saving them in some cases, and then they get lent the money by the same very banks at a higher rate. So it will try to explain the processes of central banking and try to understand why it is the case, and why, in my opinion, it does not, the abnormality of the situation does not imply that we should go to a model in which the state would get financing directly from the central bank. So a very important concept for understanding central banking is to understand the importance of independence. Independence of the central bank vis-a-vis of the authorities, meaning the state. So why is it important to have an independent central bank? The first fact is that the state is not an angel. By this we mean that the state is actually made of different political persons which also have their own agenda, their own political agenda, and that it would be very unwise to put the economic policies of a whole country at the mercy of some politician that may use the central bank and the printing of money to reach some political goal that would not be helpful for the country. For example, the recent studies have shown that in countries where there is no independence between the central banks and the state, meaning that was a few decades ago, the monetary policy tend to be more accommodative before the elections, meaning implying that probably the party which was leaving the power wanted to hold to power and was using an easing of the monetary policy to smooth the economic situation, no matter the future consequences, and first get re-elected. And very recently, you have this market commentator who pointed out that this new QE3 of the Fed, QE means quantitative easing, actually there might be some political reason behind it, meaning that maybe because Obama said that the Bernanke would be re-elected if he wins power, then Bernanke would have a more accommodative stance. So it's not sure. It's an explanation, but you see that you cannot leave the command of the economy to depend on the political cycles, because every easing of economic policy will have to be paid back. And this is a more general problem in between the adequation of the political times, which are very short, like 5 years or 7 years, and the more broad economic cycles, which require sometimes planning, but 10 years in advance, and whose effect you only see with a lagged time of maybe 10 years. In the same vein, in the same thinking, you could think of the economic successes of China, who is like playing chess and buying commodities and buying everything that will be helpful for its future economic development, Because China, contrary to the Western countries, it has a very long political agenda. The party is there to stay and it wants to stay. And because since they adopted capitalist policies, they cannot justify legitimacy based on the ideological communist thing. So the legitimacy is based on rapid growing economic successes. And that is why they are so concerned about ensuring that the country continues to have these economic successes. And this is this is really out of the subject here, but it could be a nice way to reflect the pitfall of the short time that we have in democracy, and to compare it with the longer term policy employed by China. Um, but that would be for another lecture, and that would be more focused on political institutions. The second fact here we have to remind us is that most of the inflation or hyperinflation times that the world has known are always linked with states printing money to pay off its debt. So it has been almost a constant. It has been through the centuries the case. The Roman Empire had this problem where they were taking gold out of coins, and so the value of the coins were decreasing just because the state was in debt. And hyperinflation is a time where you do not control inflation anymore. So even if some economies define it with rigorous measures, like more than 50% of inflation per month, not per year, basically it means you are not controlling the money, and that your economy will suffer because the money you are using is going basically to disappear. And this has enormous economic cost, and this should be avoided at all cost, I would say. So because the state and the intervention of the state, and particularly when it is linked with public deficits, is very often the main cause and the root of hyperinflation, it is a consensus among economists that independence is really necessary. And for example, again, I would take again the example of China. They have an independent central bank. I don't know in practice how independent it is, but at least in theory, China, which is a really state-focused country, right? It's a totalitarian region after all. They decided that independence of the bank was better. Also, in practical terms, you would question how independent is the Federal Reserve, the central bank of the US, from the Treasury. And actually, I don't think there are many serious economists that believe that they are in practice independent. But probably things would be even worse if they weren't. But I mean, in practice, they are too closely linked. This would be again another subject. So let's just go on. Here we have the concept of independence, and we do not want to link the state, particularly the politicians, with the conduct of monetary policy, because we have a looming danger of hyperinflation. Now let's talk about bank financing. When I say banks, we are talking most of the time of commercial banks. That are banks where you put your money and from which you receive the very expensive fees for many things. Sometimes services that you did not even ask for. Okay, so these commercial banks, they have some kind of, also they have a bank, meaning that they hold deposits in a special bank, which is called a central bank. So for depending on the location of these commercial banks, the central bank will be different. And they borrow money from this central bank. So when we say that they get very cheap money because the rates of this central bank, are very low, it has to be reminded that this money is always given in exchange of adequate collateral. meaning that in case of a failure of a commercial bank, the central bank would be able to seize the collateral, which is some asset, and sell it in the market to compensate for its losses. So let's look at how it works. So we have here the central bank. It has assets and it has liabilities. What would be the liabilities of the central bank? Well, mainly the money it has printed, so meaning really the banknotes, they are liability, and the deposits that the other banks are holding with it. Um, that would be the main part of the liabilities side of the central bank. There will be also the capital there, but it's not, I mean, central banks can operate without any capital because they have this possibility of printing money anyway. So capital is not necessary for a central bank. And actually, I see that in the Czech Republic, the capital is -2% of the GDP. Well, my data is from 2002, but that proves that you can perfectly operate without any capital. So then you have other choice to have capital, but so capital does not matter that much, and that leads you to the asset part. In the asset part, you would have um, the loans you have granted to the commercial bank. So here is commercial bank, for example, and it has taken a loan from you, so it has borrowed money from you, and this would constitute an asset because it is bringing you money. The commercial bank is paying some interest on the money you have lent to it. In assets, you would also have foreign assets, and you could also have claims on the private sector, but this is not the case in the euro system because we are not directly lending to the real economy. Okay, so how does it work? Suppose these commercial banks it does want to borrow money. As I said, it has to have adequate collateral. A collateral is some asset that the commercial bank has. So it can be, for example, and most of the time it would be bonds, government bonds, also corporate bonds. It could be stocks. It could be any asset such as that has been declared eligible for the purpose of the refinancing operations we are going to describe. So this collateral, when a loan is wanted, is sent and blocked in a special account in the central bank, such that if this entity ever default on the loan, then the central bank can take the collateral and go to the market, here's the market, say, and sell this and compensate part of or its losses. So here is the importance of this collateral. Okay, now we have so reside the collateral, and the central bank can say, okay, I'm going to give you your loan. So I'm crediting your bank account with me of the amount of the loan. So this becomes a liability. So liability side of the central bank is growing here. It's there. This is the money of a commercial bank that it holds in the account of the central bank. Because there is a liability, there is a corresponding asset, which is precisely the loan to this commercial bank. Now, the commercial bank can take this money and do whatever it wants with it. It does not have to justify how it is going to use the funds. And usually, well, it goes to some liquid assets and then it buys stuff from there. Now there is this problem of you have bank savings and you never know how really distinguishing between political decisions and financial stability decisions. Because as we explained, the state is no angel, and there are political pressures on politicians to make them do and take a range of decisions to help the national commercial banks. And so what may seem as help, even, I don't know, let's take an example. What may seem as an help to some country, Greece, would actually be going directly, not directly, but through interest repayment to the big banks of some countries, let's say France and Germany, who had made the bad investment in the first place. So these political decisions, they are very tricky. They are under the scene decisions that that do not say their name, and well, the market is perfectly aware that, for example, the French and German banks have a lot of exposure in Greece bonds, and so that this rescue package was also partly in order to help them. You also have financial stability decisions. If the cost to the overall economy of letting a bank fail is so high because this bank was too big, then you may want to elaborate some design to save it, or at least to go into a smooth and nice bankruptcy. Ideally, every bank should be able to go bankrupt, because this is the purpose, this is the how do you say, the ideology of the market. This Darwinian selection of the best and the more apt to live has to be respected. So I would take just one example. In France, I am with the Banque Postale, which is a postal bank. And during a lot of years, actually all the years in the booming period where all assets went up, we were really listening to a lot of arrogance from the other commercial banks, because they were the most dynamic. So La Banque Postale, the post bank in France, would be seen as the less efficient bank in some sense. But actually, they had an advantage. They had a very conservative way to deal with money. They were not investing in risky assets like the mortgage-backed securities from the United States. And I think in the mortgage subprime they lose only a few millions, whereas the other commercial banks were losing billions. So it's a factor of 1,000 there. Okay. And in a normal market economy, in what the purpose would be that these banks who were making risky decisions, they should be punished, and they should be led to go almost bankrupt, such that the winner, which would be La Banque Postale, would be able to buy them, at very discounted price. So instead of that, we kind of save the big banks and do not let the winner buy at a cheap price its own competitor. And so this is not the ideal world. This is all biased. This is biased capitalism. The winner is winning when everything goes right, and when it doesn't, it is also winning, because it has grown too big to be able to fail. Okay, what would be, so let's go on with saving the banks. In practice, the too big to fail is what dominates, and the moral hazard is well known, because every bank will make risky investment, knowing that if it has problems, then it will be saved by the government, by the public money anyway. There have been some solutions like an insurance fund. So an insurance fund for banks would work in that way. During the good times, when banks are making a lot of profits, instead of taking everything in their pocket, they would just put aside a small portion of the profits. So instead of distributing everything to the employees and the shareholders, you take some portion of your benefits and you put it in the insurance fund. Now, if there is a bankruptcy, it's the insurance fund that is capitalized and invested in, I don't know, some really low risk assets. If such things exist, then it has to be decided what is a low risk asset, because this is a class which has disappeared with the financial crisis. But anyway, assuming you have a low risk asset, that could be, I don't know, some big corporate bond, maybe. You have the money in the insurance fund to pay for the failure of a too big to fail. Now, this does not, really not eliminate moral hazard, because there is the insurance fund. The too big to fail banks and all the banks which are insured are incentivized to go into more risky investments. And they go into more risky investment knowing that if everything goes wrong, the insurance fund or the public state will be there to help them out. So the most important thing would be to separate again the trading, which is highly speculative, from the financing of the real economy. Because when we are saving a bank, very often we also think of the knockout effects of a failure of the bank to the financing of the real economy. But we do not want to propel speculation and trading. But the fact is that we do, because we are not saying in this nice scheme to the bank what to do with the money. It has at its disposal this new credited account, and it can do whatever it wants with it. Buy things, stocks, very liquid things. Propel the Standard & Poor's to the level. Currently we are in the beginning of October, and the Standard & Poor has reached the level of a pre-crisis. So pre-crisis level for the stock exchange, but things are not fixed in the economy. So it must be some awful lot of buying from some people who get some cheap money from somewhere, and who are reluctant to invest it in the real economy because we are in a downturn. So who would the risk from these guys, which are normally lower than from this guy, are also very high. So basically that would be going back to 1933 with the Stimulus Act, and that separation between the trading and the financing of the real economy and deposits and so on. Okay, so what's wrong about, instead of a bank financing, let's think about a treasury financing. What's wrong about financing the treasury directly? So destroy the banks. Well, thank you for adding a title. And finance the treasury by a direct loan. So it looks nice on paper, but we have to remember something. What would be the collateral? Because we need, collateral to give a loan. Otherwise, well, there is no limit, right? The collateral could be the same collateral as the collateral provided by the commercial banks. Very often they are the obligations issued by the state, right? So the state is issuing its own debt, packaging it, sending it as collateral, and the central bank would be giving the money to the state. So this is a very tempting solution. But remember what we said earlier? Remember what we said about the problem of non-independent central banks? If I allow a direct link between these two guys, with this guy having enormous political resources, because this is a state, what would happen is that this guy becomes a direct debtor to this guy, who is a direct creditor to this guy. So the state will try to interfere with the central bank, will try to interfere with the economic policy such that it continues to get cheap loans. Moreover, what if the state has a failure? Well, if the state, for example, is bankrupt, what happens? The collateral of the central bank would be selling the money. Well, it has no value anymore. It is dead. It is dead because the state is bankrupt. So the whole purpose of having some collateral here is completely, there is no need for, there is almost no need for collateral. There is no insurance against the bankruptcy of this guy. Okay. Okay. Moreover, it's not just about what will happen if there is bankruptcy there. It's also about what is the price of this collateral? What is the price of this thing? How much loan does it allow me to get? You see that in this procedure where the Treasury is packaging its own debt and asking the central bank for being lent money, this thing there has never received any market price. So the Treasury would be really able to say, well, it's mine, it has a very high price. I'm very successful country, and this is my price, and this is, you have to accept it and take this, and now you give me a bigger loan, okay? Because I've given you so much. Basically, you have been given only a promise to repay. It's not even a covered bond, it's not backed from anything except the goodwill of a Treasury. And it has not received any price. If you ever try to sell it, probably the market price would be something like that, right? So you are really in a bad situation. You were robbed, and this guy, because it has set such high price to its own collateral, will get very cheap loans. So yes, you do resolve the funding of the state. The state can have free money, and you know what the state does with free money? Well, great. Hyperinflation. This is what it usually ends. There is no responsible state which can be granted infinite money, because this is what the central bank can do, taking no haircut on the collateral with overinflated prices on the collateral, where you will get illimited funding, and this usually ends into the world destruction of the money. So then the state will have to say, okay, we are making a new currency. This one will be backed by something, for example, by gold or by, I don't know, another currency, like pegged to the dollar or something more stable. And so we don't want this situation. Even if we are not at ease with the current funding, whereby the commercial banks are making profits by lending money from the central bank to the state. We do not want this to happen. Now, it's still possible that, as has been done recently through the OMT, which means outright monetary transactions, that the central banks, instead of giving a loan, goes to the market. Here's a market. Here's the bond obligation from the Treasury, and it has received the price because it has been exchanged in the market. So the price is there. It's still possible that it does, well, an outright purchase. So it's buying it and putting it in the asset. It knows that this is still a market price. And this is less risky. Okay. This is less convenient for the state, because it has to sell it first in the market. But the politicians are able to make a lot of promises to the people, and now after they have to pay for it, and they always go to the easiest solution. And the easiest solution would be to ask for more and more loans from the central bank. So I hope this video has helped you to understand the very basic mechanism of the process of commercial banks refinancing, and also to share this view with me that direct financing should be prohibited, at least in normal times, and that the solution is not into going more into debt, because this is something the state has already been going for years, and changing the mechanism by completely destroying any market discipline, any pricing, would not be the solution. Thank you very much for listening, and I wish you a good day if you're in the morning, and I go in the evening. So good week for everyone, and I hope I will be making another video soon. That would also probably be about central banking. I am thinking about a video about the two main conceptions, Keynesian versus monetarists, because it's quite important to understand where people stand and what are their bias and ideas.